Hi guys, here is a good news. The IRS has increased the standard deduction for tax year 2026, and it could lower your taxes. But it works differently for W-2 employees and self-employed workers. First, let's understand. What is standard deduction? The standard deduction is a fixed amount IRS automatically subtracts each year from your income so you don't pay tax on total income. And IRS has increased the standard deduction amount for the 2026 tax year. That means more of your income is tax-free before income tax is calculated. Here are the 2026 standard deduction amounts. Anyone filing as single or married filing separately, the standard deduction is $16,100. Taxpayers who are filing as married filing jointly, the standard deduction is $32,200. For the head of household, the standard deduction is $24,150. Plus, there's an extra deduction if you're 65 or older or legally blind. Look at this example. Let's start with a regular W-2 employee. With the filing status as single, the annual income is $60,000. The IRS subtracts the standard deduction of $16,100 from this amount, leaving the total taxable income to $43,400. This means the income tax applies only to $43,400, not on your full income. Here is the key takeaway. The standard deduction reduces taxable income for W-2 employees, and that typically lowers their tax bill. But if you're self-employed receiving Form 1099, the standard deduction still helps. Not with your self-employment tax though. This is how it works for self-employed folks. Let's look at a typical example, how it originally works without taking the expenses off. Filing with the status as single, total income on 1099 comes to $60,000. SE tax 15.3% on all of that income. But here is the interesting part. As self-employed, you are allowed to take your expenses off from your gross income. If your total expenses were $20,000, deduct this $20,000. Now your total income comes to $40,000. SE tax will be paid on $40,000. So, self-employed folks pay income tax like everyone else, plus that separate 15.3% SE tax calculated before the standard deduction. Keep in mind, the Social Security wage limits and possible additional Medicare tax at higher incomes may apply. A simple breakdown of how self-employed income and taxes works differently. If you are self-employed and receive 1099 with the gross income of $60,000, and if you take off the business expenses in the amount of $20,000, that would leave $40,000 as your net income. Self-employment tax is calculated on this amount, $40,000, before the standard deduction comes into play. However, the IRS does not calculate self-employment tax on 100% of your net profit. Only 92.35% of your net profit is taxed for Social Security and Medicare. After IRS adjustment, the total taxable amount for self-employment would be $36,940. Self-employment tax is about 15.3% payable on $36,940. The self-employment tax is payable to the IRS. The standard deduction does not reduce self-employment tax. It only reduces income tax. Your income tax may be zero, but as self-employed, you still pay self-employment tax to the IRS on your net income. Guys, these examples are for educational purpose only. Your actual taxes will be calculated on your gross income and filing status. Guys, if you found this video helpful, please consider subscribing to the channel and sharing this with friends and family. With your support, this information can reach to more people who need clear and accurate tax guidance. Follow along for more simple explanations that help you stay informed with latest IRS updates. Thanks for watching.